Hi everyone, my name is Simon Mishevich from Optimize Accountants, and in this video we're going to be talking about buy-to-let investment basics. Absolutely, the basics. What do you need to be a successful property investor, and what do you need to think about to make sure you do not make a hash of it, which many people do. So it's always worth looking at the stories about successful people, but also to look at those that haven't made it and what you can learn from them so you do not make the same mistakes. Before we get into the detail, of course, you can get free online tax calculators by visiting our website using that QR code just there. What is buy-to-let investing? In principle, it is buy-to-let investing in the UK refers to the practice of purchasing a residential property with the primary intention of renting it out to tenants, rather than using it as primary residence. This type of investment allows individuals to generate a rental income and potentially benefit from property appreciation over time. Now, why invest in property? What are the options? There are a couple of things that you need to think about. Capital growth. Should you hold and keep it without really worrying too much about rental income? As long as the property washes its face, you're not too bothered. And then you flip it, you sell it down the line. That is one option. The second one is to get rental income, to have an asset that generates a good rental yield so that you can make money from the property month in, month out. If you need some advice, whether it's for UK or US, feel free to use that QR code on the right-hand side. We need to look at capital appreciation. Why house prices increase in value? Now, on the time of this video, house prices may be going up, house prices may be coming down, and there are many factors that could have influenced this. Let's get into that. Firstly, supply versus demand. If there is not enough supply, as in people do not want to buy houses, then house prices cannot go up because there may be a glut of supply, lots of people trying to sell houses, but not many people wishing to buy. That could happen if there is a recession or mortgage interest rates are soaring high. That will put people off from buying property, and therefore there isn't going to be too much demand. Conversely, if there is a buoyant economy, low interest rates, then people will want to buy property either as a home or as an investment, pushing prices up. Economic growth. Now, if we're in a country where GDP is going really well, feel-good factor, people being employed, salaries going up, then there is going to be ample amount of money to purchase properties. Conversely, as I said before, if there is a recession, then people will be holding money to protect their families from hardship in the future, which means that they don't have money to buy homes with a greater value, and therefore that could push house prices down. Infrastructure. You could be going into an area that is in development. The area that I can talk about eloquently is the East Midlands. So we have a nice airport, but we have an infrastructure support now whereby there is lots of distribution channels going straight to London and other destinations for freight. So we have warehousing, we have bigger businesses coming into the UK because of the infrastructure that we have in Nottingham in particular. Which then leads on to government policies. Now, government could really influence what goes off in certain areas. I know for sure that there are ports now being developed because of the government policies. In those areas where ports are being developed, that will increase employment in that area. More people will move to that area because of jobs, but also because the distribution links will be better for their businesses, therefore pushing house prices higher. Interest rates and inflation as economic growth, and we could look at the conversely now on interest rates. If interest rates are high, mortgage interest rates are high as well, that could put people off. But if there is a decrease in mortgage interest rates, then people might be more hopeful that prices of property might go up because of interest rates going down, therefore a great combination to buy property. Inflation is also a consideration. If there's high inflation, people cannot live day to day, then how can they afford to save up money to buy a new property, a bigger property for their family? If they're buying goods on fuel, food, all the basics, then they cannot save. Therefore, they cannot buy a more expensive home to move into. Therefore, there's going to be a cap of where house prices might end up. Financing your investments. How do you finance an investment? If you're getting into real estate property investing, you're going to need to get some finance. One of the things you may need to think about is your deposit. If you're looking for a buy-to-let property investment, then you may have to pay 25% of the total property price. So if you're looking at a property for £100,000, don't make me laugh, then £100,000 would equate to £25,000 as a deposit. That is a quite substantial amount of money that you have to save up to make that investment. We also need to think about, well, where does the other 75% come from? Well, a mortgage comes from a bank and they charge you interest rates. Now, what you may need to think about as well is getting a buy-to-let mortgage may be more expensive than getting a mortgage on your own home to release equity in your property to then put into a new buy-to-let property investment. Taxation. What taxes do you need to think about? There's income tax or corporation tax, depending on how you buy the property. If you buy property in your own name, you will be paying income tax on that property on your personal self-assessment tax return. If you buy a property inside of a limited company, however, then you pay corporation tax. So you'll have a different set of accounts to create, and then a tax return goes to HMRC and you pay corporation tax. At that point, you also need to think about double taxation. If a property is inside of a limited company, you're eventually going to want to take money out of that company, and therefore you will suffer double taxation. Section 24, use a limited company. Why am I putting that? Well, Section 24 attacks landlords that owns property in their own personal name. It means that you cannot offset mortgage interest costs against rental income. It does get you a 20% tax reducer on the mortgage itself. So as a basic rate taxpayer, Section 24 doesn't really impact you greatly. If you are a high rate taxpayer, then you used to be able to offset mortgage interest cost and therefore getting 40% tax against that mortgage interest cost. Not anymore. You're only allowed to offset 20% on the mortgage interest cost, which means that you still pay 40% tax on the profits. And because of this, there are a lot of landlords that have property in their own personal name that are paying 135% tax on the profits they make. That's right, 135%. That means they're paying HMRC more money than the profits they're actually making. Couples tax focus. If you are a couple, so many mistakes I'm seeing whereby husband and wife are married and a husband buys a property and puts it against his name. He is a high rate taxpayer. He's paying all this amount of tax and he may have a stay-at-home wife, and vice versa, by the way. You could easily have a career focused lady who has a husband that is looking after the children. It doesn't matter which way around it is. What I'm emphasizing is that there is a tax opportunity to shift the income of that property from the person that is a high rate taxpayer to the person that is a basic rate taxpayer. And that means there is going to be efficiencies to be made. Keys to success. What does it take to be a good investor and to make a good investment? Well, I believe set your goals, be crystal clear. I want X by Y. Now, there's a lot of people that I see at property investors network meetings and other property related items like that, where people get together, talk about property. And the thing I see is that people copy one another. They will say things like, I want 10K per month. Well, someone that is earning 8K per month may aspire to earning 10K per month because they understand what 8K feels like. But I do see a lot of people that are making currently £1,000 or £2,000, and now they're setting their goals to £10,000 per month. I'm not saying that is a bad thing in terms of aspiration. I'm just saying, do they actually need that to be considered a successful property investor? Someone that is earning maybe £1,000, £2,000 per month now has an inspiration to get to £4,000 or £5,000 per month is actually a good yardstick to achieve. And can you get that in a space of 2 to 3 years? Yes, you can. But don't set yourself a goal that is too far out or actually not relevant to you at all. Second thing is align your investment activities. As we said at the beginning, if your strategy is to get capital growth rather than rental yields, then you need to make sure that whatever property investment strategy you have aligns itself to get that capital growth. So there is no point if you're looking for good rental yields where you're wanting a rental income to support your life or to give you more money to have a better life, then there's no real point buying in London because the rental yields are so small. You are better to invest in places like Manchester, Liverpool, Birmingham, Nottingham, or even Scotland and the North East because they give you better rental yields. And conversely, if you're looking for rental capital growth, I should say, then why would you invest in places like Scotland when they may not have such great potential of increasing in value in terms of absolute values? Percentages, fine, but absolute values, can they go up from 300,000 to 700,000? Probably not. You need to do your market research. Get comfortable with numbers. The best successful property investors, or even best business successful people, are those that are comfortable with numbers. At the end of the day, if you want more money in your bank account, that is a number. And unless you are comfortable with numbers in business, what is income? What is expenses? How do I control that on a month-to-month basis? Then you will not be successful. There are too many people at the minute that are buying investments and do not look after them. They believe that going to these networking events will help them become millionaires. That is not where you become millionaires. You become millionaires by looking at your financial projections and going to work. At due diligence, always make sure that you're buying the right property in terms of its condition. Is it going to fall down? Due diligence on the market. Am I going to get the numbers I'm expecting to see? And due diligence, get someone else to do it for you or at least with you. Too many times I see people doing due diligence and then tweak their spreadsheet to make sure that the numbers comes back to what they want to see. And then they buy the property and guess what? Those numbers do not come into fruition. The original numbers did. And if they kind of spent more time on their due diligence, not doing a number on themselves, then they could have avoided a bullet. However, there are too many emotional vices on a particular deal and then they jump straight into it. Action list. Again, you need an action list. What are you going to do now that will help you become successful? Write it down. Make sure you set yourself deadlines. And if there are people that's going to help you do those things, how do you make sure that they do it on time to the standard that you want to have them set? But an action list is so key for you to be successful, be it in property or indeed in business.